The following program is a presentation of the Options Insider Radio Network. For more programs, visit www.theoptionsinsider.com or search for Options Insider Radio in iTunes. It's time for Volatility Views, the premier radio program for volatility traders. Each week, we'll dive into the world of volatility, how to manage it, profitable strategies, and how to avoid the pitfalls of trading volatility. If it involves volatility, you'll find it on Volatility Views. And now, the Volatility Exchange is proud to present your hosts, Mark Longo and Don Schlesinger.
Welcome back to Volatility Views, and I hope all of our listeners out there are having a fun and a profitable trading week. There has been a lot going on in the world of volatility over the past week, and a lot to dive into. My name is Mark Longo from theoptionsinsider.com, as well as many of the programs here on the Options Insider Radio Network. And I am joined by a new cast of characters today. Well, they've all been on the show in the past, but it's been a while for one of them, and for the other, he's usually not here live, so it's a rare treat to have him live. I'm joined today by Don. Actually had to take the day off. He's got some other business to attend to. We were lucky enough to bring on Bob Krause, the CEO of the Volatility Exchange. Bob, welcome back to the program.
Thank you, Mark. I really enjoyed the last time we spoke. I guess that was about 10 shows ago now.
Yeah, that was a while ago. That was down in Savannah at the OIC show.
Yeah, I had a good time. That was a nice place, too.
And yeah, I didn't see much of it. I was in that room for 3 days, but they tell me Savannah is quite nice.
Well, the room was nice, too.
Yeah, it was a very, very festive room. I had nice pictures of downtown Savannah on the wall to look at while I was talking for 3 days.
There you go.
And listeners, we are also joined live and in person by Mr. Seabass, a.k.a. Mark Sebastian, our volatility pit reporter. Mark, welcome to the program live for a change. Woo! And listeners, if you're wondering why he sounds so good, he is indeed using that nice Yeti microphone that makes him sound so thick and lustrous. Much better than the cell phone from the Board of Trade atrium.
Well, but there's something to be said about, reporting from the Board of Trade.
Yeah, that's true. There is an immediacy to that.
The hub of the VolContract future.
All right. And with our team assembled, we will dive right into our volatility review.
It's time for the Volatility Review.
All right, and welcome to the Volatility Review. This is, of course, the portion of the show where we discuss and look back on the volatility action over the past week. And there has been a lot of action to detail, and we'll kick things off with you, Mr. Seabass. I know you and I have talked on and off a bit, and we talked actually at the beginning of this week on our other program, the Option Block, about the interesting interplay we were planning to see between the weekend coming out and what impact that normally and typically has on volatility and things like the VIX, and then big numbers like non-farms that were lurking in the mist today, actually. And so the traders couldn't do what they normally do, which is take the weekend out and take some of the gas out of the volatility earlier in the week, Wednesday into early Thursday. Instead, they had to keep their powder dry going into the big number today. That's pretty much what we saw. Is that what you saw from your vantage point as well?
Absolutely. I mean, there's a reason why S&P is down about 20 and the VIX is up a point. And if the SPX rallies about 6 handles from here, we're going to be dealing with the VIX probably down on the day. We saw a lot of uncertainty come out of the market. We're seeing the long weekend come out of the market. And truth be told, I don't know why, but I'm looking at the jobs report and only being down 20, and I'm going, okay, this was a massive so what number, and nobody really realized it. I guess they're not really paying that much attention to this number for some odd reason, but that seems to be the case.
Yeah, it didn't seem to me to be the dire pronouncement that some people are turning it into, that, oh, the economy is lackluster. I mean, is that any great shock to anyone at this point? The numbers were essentially unched, which I think is actually marginally decent.
And if you look at the way they're unched, private industry is growing, governments are firing. And, the truth is every government job lost, eventually, at least some of those end up in the private sector. It's just true. That's one of the reasons why I'm a big fan of government layoffs. I'm all for it.
Spoken like a true libertarian, sir. But yes, we also cover the broad spectrum of volatility products on this program, and that includes the VolContracts that are lighting up the tape over there on the CME in the euro. And Bob, I'm not sure if you heard last week, but Don and I had a little gentleman's wager. Well, actually, it wasn't a wager. I was on the same side of the trade as Don. We both wanted to do the 3 vol, 1 vol spread where we were shorting the 3 vol contract and picking up the 1 vol because it looked like there was some discrepancy there to be exploited. And it looks like if you did that trade, it fared pretty well.
Yes, you did make some money, not a, travel around the world kind of money, but it did work in your favor. Originally, Don suggested buying the 1 vol, and that settled at 9.55 last Friday, and then selling 2.5 3 vols at 3.58. I'm sorry, at 11.58. And he was basically talking about the almost like an arbitrage. Now, the reason that they're so closely related is they both expire at the same time. They both cover the same amount of ground from here. The 1 vol started when the August options expired, which was around the, around the 5th or so of August. And then they expire on September 9th. And so both the 1 vol and the 3 vol have the rest of this week and next week to go. Well, the rest of this week today and next week to go. So we have 1 more week to go. And so far, how you doing? As of the settle yesterday, the 1 vol dropped to 920 and the 3 vol dropped to 1123. And so what that means is that we have a 30-cent loss on the 1 vol, and we have a 35-cent gain on the 3 vol. But again, remember we did this in a 1 to 2.5 ratio. So that 35 cents actually turned into 88-cent gain. So we have a 58-cent profit on this position. Now, why did we do it 2.5 to 1? That's because the 3 vol already has most of its data logged in, and that it moves or has a volatility of its volatility about 40% that of a 1 vol. So every day that goes by, it's muted about 40% as much as the 1 vol.
Yes, I think that was a great trade, and we discussed that on the show last week, what exact ratio to implement to make that 3 vol and that 1 vol essentially on the same page. And in fact, we have a listener question about that same topic, which we can get to. Go ahead, Mark.
That trade's almost like one of the, the trade, the way that was structured was almost like some of these across the street. It kind of sounds like almost like one of those complex ETNs. That could actually be, it almost sounds like it could be its own ETN the way that trade was constructed.
There we go. Licensing fees are in our near future.
Yeah, we could call it the Option Insider ETN network. And first one will be the VolContract, Euro VolContract swap, front month, the 1 vol, 3 vol swap.
I like it. I'll get my branding people on it right away.
What do you think, Robert?
Yeah, absolutely. The one thing you should be aware of or think about, we can't call it an arbitrage because it's not a perfect match. As volatility changes, the 1 vol and 3 vol will log those returns a little bit differently. It's approximately 40% as sensitive, the 3 vol is, to the 1 vol, but it isn't exactly. So it's a very, very close spread, let's call it that way, but not quite an arbitrage.
It is a approximate arbitrage, we'll call it that. We can deal with approximates here.
So then, since if an arbitrage is a perfect match, do you and Don say that you're an arbitrage for each other?
Well, I'll answer that question later when I get to I had something to talk about, and where Don and I actually have knockdown drag out fights on this one. So
I'm gonna go into the next room and tell my wife she's my arbitrage.
there you go.
I'm sure that'll work very well. Honey, you are my arbitrage. All right, and with our wives suitably offended, we're going to close out the volatility review segment and roll right into the volatility viewpoint segment.
Now it's time to discuss volatility and volatility trading strategies on Volatility Viewpoint.
And welcome to the Volatility Viewpoint segment. This is usually the portion of the show where Don and I discuss some volatility topic at length, or we drag some poor soul kicking and screaming on as our guest. But this week, since we have Bob on the show, I think it's a perfect time for Bob and I to discuss some interesting topics that have been crossing his path down there at the Volatility Exchange over the past few months, and interesting topics that have come up to some degree in the show in the past, but I think we can take a different slant, a different take on them today. I think we'll kick things off with the topic of correlation, or perhaps inverse correlation. And that is indeed something that we've discussed many times on the show before, the perception that a lot of people have out there with implied products like the VIX and what have you, that they are this perfect inverse hedge for the market, and we see a lot of people, particularly retail, diving into those products to use them in that capacity and then becoming surprised down the road when they don't exactly perform the way people expected. But the expectation of inverse correlation is that it extends not just into the implied realm, but also into the realized realm, where guys like you tend to spend your days, Bob, and you're seeing a lot of people still even diving into your realized products, still coming to it with that same perception, or I suppose you could say misperception, that volatility is this perfect inverse hedge to the marketplace.
Well, I would say that you're exactly right, except that it's not perfect. Okay, so
exactly.
First of all, you guys have mentioned, you and Don have mentioned on the show several times about the negative correlation between VIX, or implied volatility, and the market. Well, that extends, as you say, into realized volatility as well. It happens that there is a high negative correlation with realized volatility as well. Now, that's not quite as intuitive when you think about it, because we're measuring the movement regardless of direction, the actual movement. And if you were to plot some of these movements, you'd see that there are high moves up as almost as much as there are high moves down, or big moves down, let's say. And the issue, though, is that the big moves up always seems to occur after the big move down. After you get a 10% drop in the market, you get a 5 or 7 or whatever percent pullback.
Yeah, exactly.
Just like the flash crash. But so when you measure this, when you plot this on a chart, you'll see that there are huge realized volatility values when the market's going down, precisely because they jump back up really fast at times. So I just wanted to make the point that that's not only possible, but is part of volatility in general, that there's this negative correlation with the market, either in implied volatility terms, either in this perception, or in realized volatility terms. Now, let me go back, years before I even thought or heard about volatility. A wise man said to me, who I don't remember actually, but he said, "I can tell you whether we're in a bull market or a bear market. Is the latest correction the start of a bull market, or is that, the start of a bear market, or is that just a pullback in a big bull market?" So he said that he related it this way, that the stock market, as you've heard before, climbs a wall of worry, right? And then everybody, as we hit new highs and the market just pulls back a little bit, everybody goes, "Oh, this is the big one. Oh my God, I better get out." And as they do that, it starts moving down faster, and everybody starts believing, oh my God, that was the high, this is the big one, and I got to get out. And so what happens in a bull market is the market rises slowly and goes down fast. And this is the opposite of a bear market. And now it sounds intuitive, but in a way it doesn't, because what you should be doing is looking at the market saying, did we go down really fast? Well, then we're probably still in a bull market, just a bull market correction. If we start meandering down, if we start eroding down, then we're probably in a bear market. And what happens then? Well, when we get lower and lower, the people's perception is, or the trader's perception is, as soon as it starts turning, oh my God, that was the bottom, I got to get in. And the market screams up very quickly, and then it starts drifting back down again. So a bull market goes up slowly, down quickly. A bear market goes down slowly and up quickly. Well, now how does that relate to this negative correlation and volatility? Well, almost all of the huge moves have resulted in essentially retracements where we've gone back a substantial way. Maybe not new highs. We've kind of been bouncing around here for a long time. I think Don was saying about a month ago that he had a seminar data, and he had data from, I don't know, 12 or 14 years ago, and the numbers are exactly the same. You know, everybody thought he just updated the numbers to make it look like everything's current, but in fact, they were the numbers of 12 years ago, and the market really hasn't gone anywhere in that time. So I guess it's really hard to figure out right now whether we're in a bull market or bear market, but this general perception of, you know, is the market going up slowly and down fast, or down slowly and up fast, I think could help people determine whether we're in correction mode or long-term trend mode.
Yes, we see those erratic movements like you described. Typically when people are afraid that they've missed the turn, they've missed the bottom, so they pile in. You see a lot of retail diving in, getting these quote-unquote dead cat bounces that last for maybe a session or a few sessions, and then we slowly retrace back down again. But yeah, we see a lot of that as people attempt to market time and dive in and feel that they've missed whatever dramatic turn or dramatic development is occurring in the market at that time. They feel they've missed it. They need to pile back in. Hopefully our listeners of this program are a little more nuanced, but you never know. We all fall prey to those types of traps and those types of movements every now and then. Speaking of these types of movements and how they tend to impact vol, I know one of the things you and I discussed in the preamble to this show, and I know it's a bit of a taboo subject, so I don't want Don to get mad at me when he comes back on the program in a week or two and say, what were you talking about that stuff for? But it does tie into a bit of what you were just discussing, which is, of course, that somewhat controversial subject of the volatility feedback effect. And I know, for one, Don is not a huge fan of this concept, but Bob, I know you are. So maybe we'll start off with having you detail a little bit of what that is for our listeners, and maybe we'll dive into some of the reasons why it's so controversial.
Okay, well, I actually came up with this idea on my own, so I would say that it's original, except when I started doing research, I realized that there's a body of knowledge.
There's quite a bit of work out there on volatility feedback, at least that I've seen.
Yes. And so I didn't see any of that until, I came up with the idea, and then, and that's when I started researching it. But essentially the idea was, is the market trying to forecast future returns? Well, let me stop there. Is the market trying to forecast future returns? I'm buying Apple stock because I think that it can go up 10%, a year for the next 5 years or whatever. Or is the market really trying to assess future risk? Why isn't there people clamoring to buy shares in our company, the Volatility Exchange? We've had one of the independent boards of directors, Richard Sandnor, say that this could be $1 billion company someday. Well, why aren't they paying $900 million right now? Well, partly because there's huge risks to doing this. We haven't proved the concept, so much. I mean, we have one product out there, but we're far from being the billion-dollar company, and a lot of things could go wrong. We might not, just as an example, we may not have market acceptance. We may not get market makers to, everybody likes it, but we don't get quotes on the screen. One of the officers could fall ill. Who knows? There are a million risks that this venture could not be, or maybe not achieve its billion-dollar, potential. So that risk is being assessed all the time. And somebody says, well, I'll give you, $5 million for the company. I'll give you $10 million for the company. Well, we're not going to sell for that, but you get the idea that, yes, it may be worth that, but there's huge, huge risk involved. And so how does that relate to the general stock market? Well, when the traders are reassessing risk, they're looking at a tsunami in Japan, they're looking at, the blowup of Greece, domino effect into Germany and investment banks and blah, 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 all those kinds of things. They're not really saying, oh boy, I got to sell stocks. They're really saying, the market risk is much higher now, or going forward, it's much higher now. And so, consequently, what's the effect of that? The price of equities has to go down because future buyers need to have this expected return based on risk. The risk and reward kind of that elementary feeling of risk and reward. So what I'm trying to get at, or the bottom line here, is that I believe that for the most part, traders and investors are really focusing on and trying to assess future risk. And when that risk rises, the prices of equities must fall to compensate future buyers to jump in at these, quote, risky levels. So there's a cause and effect. Higher perceived risk comes up with lower stock prices, and whereas there isn't really a cause and effect the other way. If the market starts falling, why is it that volatility needs to rise? I'm not sure that there's a good answer for that. Yeah, I've heard all kinds of perceptions that, it climbs the wall of worry, people panic, that kind of thing. Everybody tries to get out at the same time. I understand all those things, but there really isn't a cause and effect the other way. If the market goes down, there's really no reason why volatility must rise. But when volatility rises, there is a reason why the market must fall. That's the bottom line.
So I suppose we should bring you back on when we do our great Skew spectacular that Don and I have been threatening to do for some time, and we can debate that a little bit about why there is such a volatility premium to the downside, and there is this ingrained, indeed modeled expectation that as the market trends downward, volatility must increase. And we discussed some of this on a recent show about the put buying activity driving up volatility levels and that sort of thing to the downside, and that there tends to be uneven paper flow in a lot of these products where large institutions and customers tend to sell calls and buy puts in large numbers, and that tends to skew the volatility. So there's a lot of, I suppose you can call them technical reasons why the skew exists and why the volatility is priced that way. But I suppose if you look at it from a purely fundamental perspective, there may not be the pure correlation people think of between the downward movement and the increase in vol. Is that what the controversy is between you and Don regarding this? Don doesn't subscribe to that?
Well, the controversy is that he believes that, well, I won't put words in his mouth, but essentially, as I understand him, that, the market goes lower and volatility rises. It's just that all option traders, all implieds, everything about risk is the effect of the cause of markets falling. And I think it's the other way around. So what I propose, actually, I'm not the, like I said, I kind of thought of this myself, and then I found out that, this has been out there for a while. what I propose and what I'm trying to do is get Robert Engel to come back. He subscribes, at least in theory, if I'm reading him right, to my viewpoint. And Don has a very strong, the opposite viewpoint. We'll never actually settle this argument because these things happen simultaneously. You know, as future risk premium is rising, well, the market's falling. So you can't chop them up and say, well, you know, risk went up, so the market falls. And it doesn't happen the day after or a month after. They happen simultaneously. And that's why I believe that there is this high negative correlation, that there is no cause and effect to just the market falling and having volatility high, but there is when volatility is increasing that the market has to fall. So I'd love to bring back Robert Engel on that subject. I think he and Don would be a really good show.
Well, Don and I have talked about bringing him back specifically for that great Skew spectacular we're talking about doing. So that might be a good time to bring him on. And like we said, get into all of the meat of this, because like I said, we touched on it recently in a little bit, some of the causes and reasons behind the equity skew, the investment skew that we see in the market right now. But it'd be fun to have more people come in and chime in with some different and varying opinions. We could have a nice little debate going. I'm sure our audience would love that. Bob, you and I think we could go on for quite a bit, but I think we've hit on a number of topics. I think we should save some for another episode because we are getting close to the hour mark here. But before we go, we have an interesting question that's been sitting in our mailbag for a little bit. I think it's a good one for you to answer. So I think we're going to close out our Volatility Viewpoint segment and roll right into our listener mail segment.
Listener mail. Listener mail. Listeners write in.
All right, and welcome to the listener mail portion of the show. And this is the portion of the show where we crack open the musty old mailbag and we dive into the feedback and the questions and the comments that we receive from you, the listener. And like I said in the last segment, since Bob is on the show this time, it's good to get his perspective on this. This is something that we've covered, and Don and I have covered in the past, but I think it's good to refresh our listeners' memory on this one. And since it is VolContract specific, it's perfect for Bob. And the question comes from our forum by one of our users. It goes by the handle Jester, and I'm sure he's quite the funny guy. And the title of his question is 3 vol versus 1 vol difference. And he writes, guys, refresh my memory, please. Why exactly is selling a 3-month vol contract not the same as selling 3 consecutive 1-month vol contracts? Is it analogous to the difference between writing a 3-month option versus 3 consecutive front-month options? I know that the sum of the decay of those 3 front-month options will be greater than the sum of the decay in the 3-month option. Is it the same with vol contracts? Thanks in advance, Jester. And like I said, Don and I have discussed this in the past, so I think, Bob, it's perfect time for you to take this and give our listeners a little refresher on the differences between on the 1 vol and the 3 vols, and indeed the differences in the volatility formula itself that lead to this.
Okay. In some ways, I believe his question or his thought process is correct. You know, selling a 3-month option or straddle, let's say, and selling 3 1-month straddles is not the same, and they're not the same for vol contracts. So in that respect, that's true. But the effect is completely different. I mean, it doesn't really have, vol contracts don't really have a decay. You know, you don't have that. And with options, you know, you get paid for that shortened time of risk. But let me relate it to you. I think the easiest way that I think of it is that volatility is a square root function, which means that it's essentially a curve. And so think of, you know, drawing a 3-month curve on a piece of paper and then drawing a 1-month curve. Well, whatever kind of curve you draw, and you know, regardless of whether you draw it correctly or not, let's just say you drew 3 different curves on there. There's no way to match up 3 little curves to 1 big one. I mean, the curves are all curving, you know, at different speeds. So I think that would be the best way to visualize this process. What happens, though, what we were talking about, what Don was mentioning about this quasi almost arbitrage trade that we had on last week, or suggested last week, is because now that we are getting into the last month, in other words, the 3-month is expiring this month and the 1 month is expiring this month, now we have the exact same number of days, we have the exact same expiration, so shouldn't they, be exactly the same? Well, they should be close, but again, think of these 3 curve ideas. The 1 month curve, you can sort of find the tangent to those 2 curves, but you can never match them exactly because the 1 month curve is much, let's say, faster or smaller in radius than the 3 month curve. So it's approximately then 40% as sensitive. Another way to think of it is that you're dragging all of this history with you. With a 1 month contract and you have 2 weeks to go, well, you have 2 weeks worth of history. But with a 3 month contract and 2 weeks to go, well, you had, 4, 8, 10, about 10 weeks of history already logged, and now you have only 2 weeks left to affect the entire period.
That's one of the reasons why I thought this question was so timely, because it did tie into that arbitrage, quasi-arbitrage, I should say, trade that we had discussed last week, and then this question came in shortly after, so I thought it was a perfect time to bring this up, particularly with you on the show again. You can give your input as well to the listeners regarding that basic fundamental difference of the 3 vol versus the 1 vol, and indeed the nature of volatility itself. I think that was an interesting question. We still receive that one on a regular basis, so it's a good one to bring up every now and then just to refresh our listeners' memories, because we do indeed get a lot of new listeners on this show with every episode, and a lot of the people who are here on episode, what are we on, 21 now, we're not here on episode 1, so it's good to refresh the memories of our audience whenever possible. All right, and that's going to do it for the mailbag this week. So now we're going to close up the old mailbag and roll right into our crystal ball segment.
And now we take a look at the crystal ball.
And welcome to the Crystal Ball segment. This is indeed the portion of the show where we tend to prognosticate wildly, or at least some of us do. I tend to hold people back. But Bob will have to let you in on our ways of prognostication on the show. We'll let you go first. We'll mix things up a little bit and talk about what you're looking at on the radar for the upcoming week for the Euro VolContract. A truncated week indeed, but nonetheless an interesting week.
Well, I'm just looking at the chart of the 1 vol and the 3 vol, the nearby, the September contracts. And the 1 vol is just absolutely getting crushed. I mean, at the beginning of August, I guess in the first week in August, it was over 14 and a quarter, something like that. And right now, or yesterday, we settled at 920. So just one contract short would have gained $5,000. So that was
bananas.
Yeah, it's a tremendous move, about 35% in the value of the contract in 3 weeks. And it flies in the face of what's going on in the world. I mean, the VIX has gone, kind of crazy this month. And the VIX is not at all-time highs, but pretty darn high. It jumped up to 40 something. It pulled back now. I think we're around 33 or in that neighborhood. But the euro volatility just got crushed, and now we're back at, let's say, normal or average values. Now, how would you know to short, or why weren't you buyers at 14? Well, if you look at the volatility cone at 14, we were substantially above the 90th percentile. And frankly, I'm not sure why everybody doesn't just put in a resting sell order at the top and maybe a resting buy order at the lower end of the range, and kind of play volatility, the mean reversion factor of volatility. That would have certainly.
The issue is that then Krause defaults and vol goes to 19 or 20. And
that's true.
which is conceivable. And looking at this, with the way currencies are right now, long-term historical mean is relatively cheap, in my opinion. And especially with kind of a major austerity vote in Italy next week, and still we don't know what's going to happen with Greece over the weekend, it's hard not to look at long-term mean as kind of cheap, don't you think, Mark?
Definitely. I mean, we've discussed this before with the pops we've seen in VIX, and I know you guys over at Volex love the Volcones. In fact, our listeners can find them and have been finding them on the volex.us website, and they typically 99% of the time are a great tool for putting in those resting orders, as you said, Bob. But once in a while, especially in this type of environment, maybe just wait on that resting orders, because like I said, we've seen so much literal weekend risk over the past few weeks that it doesn't take much to send these markets spiraling out of control. And you're right, I'm surprised that Eurovol, I should say, has sold off in such a strong manner given what we've seen in the broad market these days. You really think Eurovol would still be a little bit elevated given all the uncertainty coming out of the continent right now?
Yeah, well, the implied volatility, the perception of volatility is still relatively high, but the actual volatility, which is what we measure, is coming way down because the euro has been relatively stable.
Sorry, Bob, didn't mean to interrupt, but hey, maybe in the next week it might make sense to do kind of a option vol versus realized vol swap or something along those lines, because I just have trouble imagining realized vol staying this low.
Yes, and I agree with you. Now that we're at average, those that just look at Volcones would say, well, I don't know what to do. Should I buy or sell? It's kind of a coin flip. But I agree with you with all of the, fundamental factors and all these votes and austerity measures, et cetera. Something's got to move somewhere, and average volatility is probably low. So
that'll be a good ongoing segment for our crystal ball or volatility review segment. We could have hypothetical resting orders at the outer boundaries of the Volcones, and we could see how they perform on a week-to-week basis. But Mr. Seabass, I know you have to run shortly, so let's look into your crystal ball as well for what you're looking forward to in this truncated week in terms of broad market vol.
It's been real interesting. They're not afraid to sell premium into this weekend, and
which to me is just nuts. I mean, how many times do we have to see these shocks over the weekend? How many times do you have to learn? You're selling into Tuesday at this point.
We're starting to run into earnings. I'd be really surprised. I think we're going to see a couple M&A announcements next week that could really, in terms of stock market volatility, we're not moving enough to warrant a 32% in the VIX. We're not. And so it's going to have to continue to come down. I'll be interested. Keep waiting for VIX futures to come out of contango. Or come out of backwardation. I know we need to drop below 30 for that to happen, though. And it just hasn't happened yet. So keeping my eye on that. And in terms of bonds, bond vol and, bonds in general, unbelievable. It is safer. I can think of so many things safer than owning treasuries right now. To me, right now, at the levels treasuries are trading, it's a very risky thing to buy. Even though it's supposedly the risk-free thing to buy, I think you could really get smoked up. But the price treasuries are trading really is telling up that there's something going. Treasuries a lot of times can lead an ominous sign, or maybe they're thinking QE3, but again, I think QE3 is not going to happen. It's a bad idea. So in terms of next week, one vol higher, VIX lower. How's that?
There we go. Yeah, we have had a standing sell order on this network for treasuries and for bonds in general for quite a while. Hasn't exactly been working out too well, but we stick to our guns. But,
right, I know. I love it.
Speaking of sales, if you're selling vol into this weekend, at this point, after the non-farms, when the weekend's already pretty much out, and you're selling into Tuesday at this point, then you pretty much deserve what you get. You're giving up a free weekend with all the risk that entails for little to no, if not any gain. I don't really see the logic of that whatsoever. So if you're doing that at this point, and you're one of our listeners, shame on you, sir. You should know better. All right. And with that scolding complete, that's going to close up this episode of Volatility Views. I want to thank both of my cohorts here for joining me. And Mr. Sebastian, is there anything coming up at Option Pit you want to let our listeners know about before you head off?
Yeah, I'm doing this volatility class where actually, if you want to learn how VolContract futures trade, this is going to be the class to take. Now, I'm going to cover VIX ETNs, but the VolContract future is going to be something you need to know. And even if you aren't a currency trader, down the line, this methodology is going to take off, and you should be learning this. So you should trade if you don't trade the euro, or if you're a euro trader, trading the VolContract future makes a ton of sense. And even if you're not, taking this class makes a ton of sense. Go to optionpit.com/events. It's called A Trader's Guide to Volatility Across the Markets.
All right, Mr. Sebastian, thank you for that. Now go enjoy your long holiday weekend. I think Mark Jr. is hankering to have some vacation time with his daddy. So by all means, have a good weekend, sir. And Bob, at this point in the show, we always talk about what's interesting, what's new, what's up and coming over at volex.us. Is there anything outside of the volatility cones, which I think we should point our listeners to again because they are indeed a great tool, as you mentioned earlier. Anything outside of the volatility cones that's new or exciting or you want to point our listeners to at the volex.us website?
Well, still it's a little vaporware, but we're working with Bloomberg to try and get our indices and series data up on their system. So then they could run all of their studies and research, because it'll be within their database. So that'll be a nice thing. We're getting close to that one. And we've been working very hard on trying to get realized volatility instruments on equity indices. So that's where we've been focusing. Now it may be something happens and we launch it in gold or something else, but we're focusing on equity indices.
I know a lot of our listeners are chomping at the bit for that day when they could trade a vol contract on something other than the euro. Not that the euro isn't a hot product, but a lot of our listeners are still very equity and index focused, and so if they can have something that falls into their wheelhouse like that, I think these vol contracts are really going to start lighting up the tape. But that is going to do it for this episode of Volatility Views. I want to thank both Bob and Mark for coming on the show today, and I also want to thank all of you out there for downloading and streaming and subscribing to this program, including to the new feed that we just launched in iTunes recently. It's already lighting up the tape, and it's only been out for, I think, a week or so. So that's a good sign that people are finding Vol Views on its own, which is fantastic. Of course, if you'd like to post any questions or comments or feedback for Don or myself, or occasionally Bob here, then surf on over to the optionsinsider.com/forum, then scroll on down to the Volatility Views section of the forum. You can post your comments and questions there. You can also shoot us your questions or comments at Facebook. Just search for Options Insider or search for Volatility Exchange, or Twitter, twitter.com/options or twitter.com/volex_info. You have no shortage of ways to get in touch with us. The courageous among you can even leave us a voicemail at 312-544-9356. So indeed, thank you for downloading and streaming and subscribing to the program and making it such a success. And we'll see you next week right here on Volatility Views.
Thank you for listening to Volatility Views. Join us next week as we keep our listeners on the cutting edge of finance and risk management with lively topics relating to volatility. Volatility Views is brought to you by the Volatility Exchange. If you'd like to learn more about VolContracts, please visit www.volex.us. If you'd like to submit a question for the hosts, then surf over to www.theoptionsinsider.com/forum and post your question in the Volatility Views forum. Questions can also be submitted via email at questions@theoptionsinsider.com or via Twitter at twitter.com/options and twitter.com/volex_info. Facebook users can submit their feedback via the Options Insider and Volatility Exchange Facebook pages. Voicemails are also welcome at 312-544-9356. Thanks again for listening, and we'll see you next time on Volatility Views. The views expressed on this program are not intended as investment advice and do not constitute an offer to sell or a solicitation of an offer to buy any securities or other financial instruments and may not be relied upon in connection with the purchase or sale of any security or other financial instrument. The The opinions presented on this program represent those of the speakers and do not reflect the views of either the Options Insider Incorporated or the VolX Group Corporation. The preceding program was a presentation of the Options Insider Radio Network. For more programs, visit www.theoptionsinsider.com/radio or search for Options Insider Radio in iTunes.